Top three things in my notebook this morning. Number one, Europe. Number two, the U.S. consumer. And number three, our old friend, the 10-year bond yield. So Europe, first of all, I get up this morning, the first thing I do, I turn my eyes open and I look at the futures, and there they are. European futures, you look at anything that happened in Asia overnight, they did not care about the Candy Crush. I mean, in Italy, the reality is that they don't have the Candy Crush or the Facebook or the Twitter for that matter, and I think that that's an interesting point to make, so we'll make it this morning because, of course, Asian and European equity markets, specifically the German and Italian stock markets, didn't care. They just didn't. They don't have to. Point number two, the U.S. consumer better care because, again, if you're levered up into one of these situations where you're going to go buy a headset for $2 billion, that might pose a problem down the line. In the moment, it might sound interesting, but, again, everybody has a plan until they get popped. And, again, that's what's happening with some of these bubbles, and I would not underestimate the impact of that or the fall-through to the U.S. consumer. Don't forget that the U.S. consumer is propped up on multiple bubbles, and, again, we're already seeing the U.S. consumer slow in the face of inflation accelerating, but the U.S. consumption stocks are the worst-performing subsector of the S&P 500. U.S. consumer discretionary down 4.1% for the year to date. So if you're looking for shorts, stay there. 10-year bond yield, again, continues to react in kind with growth slowing. So again, bond yields fall when growth slows. And again, most people would say, well, if there's inflation, maybe the Fed's going to get hawkish. I mean, come on, seriously, it's 2014. The Fed has zero credibility on fighting inflation, and the 10-year bond yield moves precisely with the slope of growth or the rate of change in growth. So you can see this morning that the GDP number for the fourth quarter has got a 2 in front of it, 2.6, 2.7%. But that's off the sequential peak, and again, it's all about the slope of the line of 4.1%. The growth accelerating peak, which was our call last year, of the third quarter. So again, growth will slow again here in the first quarter, and as growth slows, 10-year bond yields will fall. Those are your top three things.